You buy the cheap one, $20, a single call option way out of the money, expiring Friday, the kind that costs less than lunch. And for that $20, you are not really buying a contract. You are buying a daydream. Because if the stock rips, this little thing could be worth 2000. You have already done the math in your head. You already know exactly how you would tell the story. Here is the trap hiding inside that $20 ticket. Cheap and good deal are not the same thing. In the options market, they are almost opposites. The cheaper a contract looks, the harder it is usually working against the person who bought it. And the strangest part of all of this is that nobody is tricking you. The price is telling you the truth out loud in plain numbers right there on the screen. You just have to know how to listen to a number. My name is ST, and I spend way too much time trying to make sense of the market. If you have ever bought a cheap option because it felt like a lottery ticket with slightly better odds, subscribe and stick around because today we are going to read the one number on that ticket that everybody feels and almost nobody actually does the math on. Let me start by defending the thing because the love is real and it is not stupid. A cheap option is one of the only places left in the market where an ordinary person can put down a tiny amount of money and reach for a number that could change their week. Buy 100 shares of a stock and a 10% move makes you 10%. Fine. Buy the cheap call option instead, and that same 10% move in the stock might hand you 400% in gains. And if you are wrong, you only lose what you paid. The downside is capped at $20. The upside has no ceiling you can even see from where you're standing. That shape, a small fixed loss against a huge open ended gain, is the most seductive shape in all of finance. It is the shape of a lottery ticket, and humans have been in love with that shape since long before anybody drew a candlestick. And we love it more every single year. The cheapest contract of them all is the one that expires the same day you buy it. Traders call them zero-day expirations. A few years ago, they were a strange little corner of the market. By 2025, they were the main event. On the S&P 500 index, these same-day options grew to roughly 60% of all options volume, and in the busiest months, they crossed 62%. Sit with that for a second. More than half of all the action in the single most important options market on the planet is now happening in contracts that are born and die inside one trading session. We did not gently drift toward the cheap lottery ticket, we sprinted at it. So here is where it starts to get interesting because the very first thing everyone tells you about these contracts turns out to be wrong. You have heard it 100 times. Most options expire worthless. People say 80% like it is scripture. It is a myth. And the real numbers are far more interesting than the slogan. The clearing data looks roughly like this. Only about 10% of options contracts are actually exercised. Somewhere around 55% to 60% of them get closed out before expiration. Traders selling the contract back before the end, which leaves only about 30 to 35% that truly expires worthless. So, no, the market is not some machine that shreds 80 out of every 100 tickets every Friday afternoon. But look closely at what the real number is quietly confessing. The reason most traders sell the contract back before the bell is that they can already see where it is heading, and they are scrambling to get out before it touches zero. Because cheap is not a discount. Cheap is a probability wearing a price tag. The price tag of an option is just the market's best estimate of how likely it is to pay off, multiplied by how it would pay if it did. So when a contract costs $20 and could theoretically be worth 2000, the market is not being generous with you. It is telling you in the only language it has that it believes the odds of that actually happening are somewhere around 1 in 100. The cheapness is the odds. You are not discovering a bargain that all the professionals somehow walk past. You are reading a price that they set on purpose with enormous care, and the price is quietly saying one word: long shot. And somebody set that price for a reason. On the other side of your cheap little lottery ticket, almost every single time, is a market maker, a professional whose entire business is selling the dream and quietly keeping the change. Now, you would think that selling long shots would be dangerous since every so often one of them detonates and into a giant winner. And it is dangerous for any one ticket. But across thousands and thousands of them, it is one of the most reliable edges that exist anywhere in finance. Two researchers, Boyer and Vorkink, studied exactly this: options that behave the most like lottery tickets, the ones with the wildest jackpot. And they found that those options delivered dramatically lower returns than the boring ones. The gap was not small. It ran on the order of 10 to 50% per week. Read that again. The more a contract looks like a lottery ticket, the worse it tends to pay the person holding it, and the better it pays the person who sold it. That gap is not an accident or a glitch. It is the fee the crowd cheerfully pays for the pure privilege of getting to dream. Even the words we use give the whole thing away. We do not call these investments, we call them lottery tickets, long shots, flyers, a punt, a YOLO. The language already knows exactly what the spreadsheet is, too polite to say out loud. And here is the part I really want to be honest about, because it would be so easy to turn this into a conspiracy. It is not one. Nobody is hiding the odds from you. There is no secret back room, no rigged switch, no memo. The entire bet is printed right there on your screen, in the price, in the numbers anyone can read. The market maker is not lying to you. He is selling you exactly what it says on the label: a small chance at a big number for a price that is tilted just slightly in his favor a few thousand times a day. The casino does not need to cheat when the odds are already painted on the wall and people line up to play anyway. Now I can already hear you because I have said it myself out loud with a screenshot ready. But ST, I hit one. I turned $80 into 4,000. I was there. I have the proof. And I believe you. They do hit. That is the entire engine. The jackpot is not the exception to the system. The jackpot is the fuel of it. The same way one lottery winner on the evening news sells a million more tickets the next morning. Your one glorious screenshot is the exact reason you will buy the next 20 cheap contracts after it. The hit is real, and the hit is rare, and the rareness is the whole point. A lottery that never paid anybody would be dead in a week. The one that pays a single stranger loudly on camera runs forever. And while you sit there waiting for your hit, the cheap contract is not just patiently holding its value, it is bleeding. Every single day that passes, a little piece of what you paid simply evaporates. Whether the stock moves or not, traders call that theta decay. But you do not need the Greek letter to feel it. Just picture an ice cube you bought on a hot afternoon, and you are betting it turns into a diamond before it melts. Most days, it melts. That is what cheap actually costs. Not the $20. It is the $20 again and again every Friday while the slow melt does its quiet work in the background. The jackpot stays one strike away, always one strike away. This is why when somebody finally measures how regular people actually do in these things, the picture is grim in a very consistent way. Studies of everyday option buyers find them losing money around the exact events they crowd into the most: earnings, big news, the loud days, with a huge chunk of damage coming not from being wrong about direction, but from overpaying on the way in and refusing to sell on the way out. And in India, where the regulator forced the brokers to publish the real customer numbers, they found that roughly 93% of active retail derivatives traders lost money over a 3 year stretch. Different market, different country, same gravity. When the product is a gently tilted lottery and you buy it over and over and over, the law of large numbers stops being your friend. It quietly becomes the house's. So, why do traders love cheap contracts? Now, you can finally see the whole shape of it at once. We love them because they are the only socially acceptable lottery ticket that arrives with a charting app and the warm feeling of skill attached. We love them because the downside is small and known and almost painless, and the human brain will happily trade 100 tiny certain losses for one microscopic shot at a story worth telling at the table. And we love them, most of all because the price hides the odds in plain sight. And a cheap number simply does not feel like a warning the way a closed door does. $20 does not feel like a risk. It feels like a coffee. But the contract was never actually cheap. The contract is priced almost perfectly. It is the dream that is expensive, and you pay for it in the $20 pieces on a schedule to calm professionals who is very, very happy to keep selling it to you. So the next time you are about to buy the cheap one, the $20 call option expiring Friday, the one that could be worth 2000 if the world breaks just right, do one small thing first. Do not ask yourself whether it is cheap. You already know that it is. Ask what that price is telling you about the odds, because it is telling you clearly in the only language the market has ever spoken, 1 in 100. And then decide with your eyes open whether you want to pay full price for a 1 in 100 dream, knowing exactly who is standing on the other side of it, smiling, ringing it up. Cheap was never the deal, cheap was the bait, and now you know how to read the hook. I'll see you on the next one.